Hi, everyone. Jim Gossard and John Richardson here once again with a tax talk. Um, John, you wrote fascinating presentation last November of 21 uh, regarding Pillar One, Pillar Two, and the implications on overseas taxation of corporations, and also what has come to be known as the global minimum tax. And, as I went through this, it is abundantly clear that this is yet again another example of why the US really has to go to CBT. This is another whopping example of the unintended consequences, in this case, once again, on individual Americans living abroad, in this case, business owners, small business owners, and how so many of them are just getting clobbered uh, by this by this series of tax laws. But why don't you take it from there, and if you would please, kind of explain the Pillar One, Pillar Two, and its implication on small business owners abroad.
Yeah, I'd be glad to do that. I mean, this is going to be the true Reader's Digest version because this stuff is A, incredibly complicated, and B, you have to be thinking about it all the time to fully understand it. And full confession, I haven't really thought about it since I prepared and did the presentation in November.
But John,
But
I
the
think
general,
we should also make it a point here. So I should have kicked it off this way. We got to make sure that we post your presentation down below so that people, because people have signed into this podcast, they probably should know the subject matter pretty darn well, but they'll have to have your presentation if they want to follow the argument.
sure, absolutely. Well, unless you've been living under a rock, you know that, you know, I mean, the whole issue of international taxation, I mean, it's actually been in the news, like the front page, people read about this stuff. And, there's this perception that, my God, these evil corporations, they don't pay their fair share. And, they're involved in something that's somewhere between tax avoidance at best and tax evasion at worst. And, all that stuff. But that's actually not true at all. And what is true is that the general architecture of the international tax system, by that I mean the treaties, were really conceived and introduced 100 years ago. And there have been no really substantial changes to it for 100 years. And one of the things that the treaties do is they say that, as a general principle, that a company has to have a permanent establishment in a country where they're earning profits in order to be taxed by that country, which we'll call the source country. So, that may have made sense if it ever made sense in a world where, you had British and American mining companies, going across the planet. But that's not what's going on today, where you have the Apples and the Googles of the world and the Amazons, what have you, selling digital services and stuff, where really all they're doing is they're accessing the customer base, the consumer base in the country to make profits. So
Sure, theoretically, it works. Theoretically, at least, it could work if you're talking about the physical export and import of physical goods.
yeah,
Once you get
well,
once,
it's more rational.
yes, more rational, better way to put it, but theoretically workable. Whereas once you get into a sale of digital products, then source country and resident country become totally different definitions.
Oh, I think so, totally. I mean, you look at a country like India, which has 1 billion people, I think at least 1 billion people. And, so let's say you have Google is selling services or Amazon is selling digital books or something like that. I mean, clearly the companies are profiting just by being able to access the consumer base in the country. And, the idea then that, well, it's too bad, so sad, we don't have a permanent establishment in India, therefore India has no taxing rights over the profits we're making there. It's really a non-starter in the 21st century. And so there's movement to reform these rules of international tax. And one of them is the idea that the source countries, say India, ought to be able to tax a multinational making profits there, even if they do not have a permanent establishment. And the rollout on this has been slow, but that's the pillar one thing, right? And the second aspect of this is, and this is very much at the initiative of Secretary Yellen, the Biden administration, was this notion that, oh my God, so the U.S. has higher corporate tax rates than perhaps in other countries. We don't want our companies to be able to, escape the U.S. and, get lower taxation. And so, we really want other countries like, say, Ireland and that, we want you to raise your minimum tax rates so that our companies, our US companies, can't find better grazing ground, so to speak, and have to pay this minimum tax. And this is what Pillar 2 is essentially about. Okay. And again, these rules are complicated. They don't apply to all companies. They depend on size, et cetera. But the question is, how could this possibly affect an individual American citizen living outside the United States, trying to run a small pizza delivery business, dry cleaning business, or a small accounting firm or something? And the
In other
answer is
words, you mean because the original target really was the major tech companies, many of whom had hundreds of billions of dollars in cash parked around the world, anticipating a more favorable climate when they might be able to repatriate that cash.
well, yeah,
That
yeah.
was the target of this tax law, and
They're the ones who are targeted. They're the ones that everybody was thinking about.
but
But the way the U.S. tax code is written, this stuff applies to. I mean, there's no difference between, John in Germany and Apple in Ireland. No
well,
difference
I
at
know when
all.
my little consulting business in Hong Kong got hit by it, I found myself paying tax on years of retained earnings, and it
Uh,
came out of nowhere. But it was
do you
the roots were the same
exactly
as what you're talking about.
exactly? I mean, do you feel that you were a multinational?
You know, I'm flattered by that, John.
I mean, Jim,
Of
you're
course not. But I got to believe that around the world, and I'm sure you know far more cases than I do, that small businesses, proprietorships, professionals, dentists, yoga studios, bars, consulting companies, retailers, small American-owned businesses around the world unintentionally got clobbered by this. And it's hard enough to get a business going outside the U.S. Hard enough to be successful in a small business at all. But when you're running a business in a country, you got to pay this kind of a tax, and not just a tax on profits, but a tax that it flows through to the principal owner immediately. And it's how do you possibly run a successful business when you got to pay these kind of taxes that your competitors don't, who are not Americans, operating the same kind of a business in a foreign country?
Yeah. Well, what these rules do, the guilty rules in that is they essentially attribute the income earned inside the company to the individual shareholder, even if they never received it, right? So, I
Right.
mean, that has two
And a
very interesting
corporation domestically, take the case of a plumber. If that plumber continues to invest the profits of the business in the business and doesn't personally take a salary, wages, bonus, whatever from the company, then that plumber, as owner of that business, is not taxed as an individual. Company gets taxed, but he's not taxed as an individual. Whereas the way this plays out for American business owners, small business owners outside the U.S. plays out in a much different way. Those owners or fractional owners are personally taxed in these situations.
Yeah, that's exactly right. I mean, think of it. I mean, there's two amazing consequences. The first is the individual business owner has to pay tax on income they never received. But the second is that, I mean, you have to think that the money to pay the tax will have to come from the company, because where else is it going to come from? It drains the working capital right out of the company,
Of course.
which, of course, is a competitive disadvantage, relative to a similar business owned by a non-American. But it seems to me that it also puts American citizens abroad in what I would call sort of a permanently downwardly mobile situation, right? I mean, anything they do. But what's interesting is that, we look at the pillar one and the pillar two, and, the US at present has not complied with its obligations because it has not gotten the guilty rules up to 15%.
Right.
At the moment they're at 10.5%. And, we've already discussed how in a general sense, the GILTI rules flow through to individual shareholders of Americans abroad. So, I mean, it's pretty obvious that to get this tax rate up to 15% is going to have it will clearly means that individual shareholders of CFCs outside the United States are subject to this. The question is, what does it mean for them to be subject to it? Well, it depends on what country they live in, what the tax rates are on the corporation, et cetera. But the bottom line is this, that more people are affected by this, far more individuals are impacted by this than the small number of multinationals, that they're trying to go after. And, there's a saying that there's a violation of equal protection when people don't get the equal concern and respect of the legislature. Well, my God, I mean, this clearly affects more individual Americans than it does corporations. And not only does Congress not care about them, but they don't even care that they don't care. And this is why this whole citizenship taxation regime has got to come to an end.
It's yet again another example of that. There couldn't be a clearer example, although it's a complicated subject, but it couldn't be a clearer example of why you can't just go in there and fiddle with the tax regime. The root cause of all this stuff is citizenship-based taxation.
Exactly. And what's fascinating to me, I mean, I watched Senator Wyden's hearings, Senate finance hearings during the March, and week after week, I saw him going off, foaming at the mouth, about all these horrible corporations and why the GILTI rules need to be changed, et cetera. And never once, not even once, was there a comment from him, was there a witness who acknowledged the reality that far more individuals are impacted by this than our corporations, these multinationals. And even going a step further, there was no acknowledgement that these are Americans abroad who are primarily affected by it.
Yeah, I mean, I can only say that as one who is directly impacted by this, who invested overseas, promoted, among other things, American businesses operating where I had my consulting business. I would not start a business like that again overseas again. Now, granted, I've retired. Okay, I've got different set of decisions than younger people might have, but I would not start a business like that again. And how could that possibly have been Congress's intent, or the Treasury's intent, for that matter? They can't
They're not even
possibly
thinking
understand.
about
They
it.
cannot possibly understand the impact of what they're doing, because clearly, the legions of American small business owners operating abroad, each are in their own way a very positive ambassador to the United States. And when they get clobbered like this, and when our laws make it so that people like me, and I presume I'm not the only one, wouldn't dare open a business outside the US again, how can Congress and the Treasury Department not understand the magnitude of what they're doing? And the root cause really is, it's CBT. It's you can't fiddle with a tax code without causing dire unintended consequences right where you don't want them to happen.
Well, that's exactly right. CBT, that is citizenship-based taxation, is the original sin from which all of these horrible consequences follow. And, to get this back to our continual theme here, there's only one solution to this, one solution, and that is to end citizenship-based taxation, but end it in a way where the United States moves to a system of pure residence-based taxation, where citizenship cannot be used as the basis for tax residency for any person, anytime, and under any set of circumstances.
Totally agree, John. John, great discussion, and you did a terrific job explaining one of the more complicated sort of aspects of this whole issue. Thanks very much, John.
Thank you, Jim.
Thank everyone for watching.